My next guest, he's been able to pick out some interesting threads going into 2025. He talks about some good data, some bad data, some neutral data. Now, I've already mentioned a few paradoxical storylines, which say Bitcoin versus the dollar or inflation and our debt. In terms of a football metaphor, I'll describe our economy like a football team. We have definite strengths and weaknesses like a football team does, right? Our strengths would be our offense, which would be artificial intelligence and our high-tech sector. Our weaknesses would be, say, inflation and our debt, right? Now, while I expect the year to be a good one, 2025 should be good, the scoreboard is going to be lit up a lot this year. And what I mean by that is our AI, our artificial intelligence and Mag 7 stocks per se, they're probably going to score a ton of points for us. But our Achilles heel will be that inflation and our debt. So we're going to win games with this pro-growth offense that the new administration is giving us. But the scores are going to be more like 78-68, if you get my drift. We're going to have to outscore our weaknesses. And my next guest, he's got some things to say about this. Please welcome to the show, Mr. David Stryzewski. David, I don't know if it makes sense that way, but it just seems like we're going to be the Loyola Marymount of basketball. We're just going to really have to run and gun and make sure we always have a couple more points on the board than the other team does. But I think we can.
Yeah, no question. I mean, I think if we were looking at 2024, honestly, I think most people would say, there's nobody who really had a perfect thesis idea of what long-term we were going to be, looking like here post this election. Why? Because the outcome was going to be so different, one candidate to the other. Plus, we didn't even know who our candidate was on the Democrat side here until about August. So the understanding has been that everything is beautiful and wonderful for the last 2 years, as we've just finished another 20 plus return year in the market, which is wonderful. I vote it does that every year. But here's reality. What goes up ultimately comes down. And we have rallied each of these years based upon the following. When we had good data, people were like, you know what? Recession's not even happening anymore. Bad data, the Fed's going to cut. They're going to take care of it. We got the Fed put in place. No problem. Neutral data, guys, it's Goldilocks. This thing's just coming in just right. Powell's in control. He's currently not in control. I think last year he finished the year 23 spiking the ball, talking about inflation's under control and they're going to have 6 cuts this year and 24, da-da-da-da-da. We obviously didn't see 6 cuts. Inflation's an interesting story as measured by CPI, or as I like to call it, CPLI, because it has nothing to do with the average person's spending. It has everything to do with just a group of expenses. And so long story short is that the economic data that we were just rallying on, no matter what, is not necessarily going to be there. So I like your football analogy a lot. And I think that you're correct that we're going to have high scores on both sides. So this is a buy the dip time frame, but there's a lot to be excited about as we look forward here into the future.
And I think if I was back managing money, I would have to be really in this managing the expectations of my customers, because slowly but surely, let's just do the time frame, right? In '08, you graduate from university with a finance degree, you get a job at Morgan Stanley or JP Morgan. You're now, you're 22 back then, now you're 38 years old, 16, 17 years later, 38, 39 years old. 5% Fed funds rate seems incredibly high to you, but you're getting used to a 20% return on your equities. I mean, that doesn't happen. I mean, there was a time, David, I'm an old man, that 8 to 10% return on your equities was good. And you used to say a 7.5% mortgage was a 30-year low. So we have to kind of massage our way into letting customers know that you're not going to keep putting up 22, 23, 32% returns on your equity portfolio. And maybe a couple of years of 5 to 10, maybe 12% on the outside would be a good thing.
Mm-hmm. Well, I think you're onto something here. And this is something that I've been talking about for a while. Since September 1981 is when we got out of this last inflation cycle. And essentially what the Fed's been able to do is anytime that we got into economic trouble, they would just drop the rates. I remember talking to my father about this growing up, like, they can't just do that forever, right? But it seemed like the answer that was going to always prevail. Well, then we got down to the zeros, and then now we're on the flip side of that. So rates are coming up right now, just as we've been discussing it, Scott. There are some big challenges here as we're looking, out with these higher rate environments. But yes, I think you're right. A 5-6% rate of return does sound pretty good until we begin to understand the risk. And we haven't really calculated risking yet because volatility has been so low. And so that's the part I think that's going to really change, because your high score example there was saying that there's going to be a lot of volatility, a lot of scoring. And so the hope is that we can just continue to be putting more points on the board, doing the right things that have a better long-term outlook, even though, in the short term, we might be doing Department of Government efficiencies, and that might be cutting back. What's the double-edged sword on cutbacks? Well, I would say that, a lot of the GDP that we've been seeing here in our nation has been directly correlated to government spending. 100%. Same with our unemployment, et cetera. So that will be a different story.
We basically spent our way out of a recession because they didn't want to have one. They didn't want to have one. So as long as they kept that money coming through, it's pretty hard to have a recession when you have an extra $1.5 trillion sloshing around the economy every year, right? I mean, that's just the bottom line.
Absolutely. And again, it leads to inflation when we have things that are out of balance. And so we have a very delicate ecosystem here. We've got to make some important decisions. The leadership in this next year, 2025, is going to be really interesting to watch. Can they represent the people? Can this thing get turned around in a way that is going to begin healing some of where things have truly been falling apart? And I know you and I have discussed that in the past here. So
I think it's going to be tough. I want them to swing hard and swing for the fences, but to try to extract ourselves out of the Fed when all they do is ever cut when we get into trouble, to try to get the excess money out of the system, there's going to be some pain, and that's the problem. Nobody's really willing to take that pain. It'll be interesting to see when Vivek and Elon start cutting costs. What do these legislators say when it's in their own backyard? They're all for it right now. But when it comes into my constituency, no, we can't do that. That's what's been happening in Europe. I'm interested to see what happens here. Lots to talk about. Absolutely. You're going to be on all year long. Really appreciate your input. Thank you very much, David. David Stryzewski coming to us.